We'll do it live.
Okay.
We'll do it live. F it. Do it live. I'll write it and we'll do it live. F***ing thing sucks.
Yeah.
All right, welcome everyone to the live stream, and it's going to be just me. We might have one guest and Andrew showing up later, but that's to be seen. So we'll be discussing all the topics that I have listed for you guys here in the title, and I think we're going to be discussing PayPal first, followed by Tesla, and then we're going to be talking about Google. The overarching theme of this or today's live stream is going to be what kind of businesses do we see that end up being strong compounding machines, and what are some things that we can try to look for in businesses today that emulate some of those characteristics. Now, Google, kind of spoiling the ending of this a little bit, but Google definitely, I think, is one of those companies. I'm going to share my fair bit of criticism with Google and Google's management team, but kind of using them as an illustration or example of a business that over the past, I'd say, decade, if not more, has proven itself as a business with an impenetrable moat that other businesses are simply too jealous of. We'll talk about Microsoft's commentary or Microsoft CEO's commentary on that. So let's start with the first bit of news here today. So PayPal announced their let's call it Tech Day. And I'm going to see if I can pull up the video here. Let me see right here. It's PayPal. And the point or the issue with this week's Tech Day for PayPal is on CNBC. They announced that they would shock the world. And I'm pulling up that clip here for us as well. So the first bit of, let me see, let me remove this, and I'll go ahead and share the screen so we can start by just listening into his words, not mine, on what the world should be expecting. And we're going to skip over to roughly, I believe it was in the middle.
Improve their conversion rate, it improves their business, it improves our bottom line. We're kicking things off on the 25th.
You do have an awful lot of data. You ever consider just selling it or working with others as well to sort of?
Oh, no, I think it's towards the beginning.
Well, look, we're an important company. We've got a quarter of the world's e-commerce running through PayPal. So that's why we've got 45 analysts following us. And, look, to be honest, there hasn't been a lot to celebrate over the last few years. I think innovation's been slow. The company's been growing, but hasn't been putting out real customer-backed innovation. And that's why I'm here. That's why I'm so excited about it going forward. So look, I love being an underdog. I will take all of that feedback and we'll shock the world.
Yeah, you think you're going to shock the world. How are you going to do that?
We've got an innovation day coming out on the 25th, where from the first week that I got there.
Okay, so for the most part, I stayed pretty quiet on the company since that discussion. Here and there, if people ask me in the club questions about PayPal, Adyen, and other fintech companies, of course, I'd answer that. But PayPal as a company has been challenged on multiple fronts. We've addressed this in prior videos and live streams. The legacy checkout button is the high margin business that they continue to kind of utilize as a cash cow. The exciting portion of their business is, of course, the competitor to Adyen called Braintree. So Braintree is taking up a lot of the growth, but PayPal, in pursuing this business, has actually lowered their operating margins by not quite a degree. Let's first talk about take rates. So if you look at take rate on something like a Braintree versus the checkout button, you're going to have a lower percentage of what the transactions that go through your system. So that we measure as the take rate. And if you see what Braintree more than likely takes, we don't have that exact breakdown offhand, but just trust me that it is lower. And you compare that to the legacy business, and then you see that the faster growing business is Braintree. It makes sense that when we see PayPal reporting their figures, the take rate is going down and down and down. Now, Adyen also has a low take rate, But for Adyen, that is their entire business. And Braintree competes more along lines of Adyen, which is why I'm using them as an example, and not Stripe. Stripe primarily focuses on the small, medium-sized business front, and they're doing a fantastic job. They're also private, so we don't get those figures exactly. Although I think that the private valuation back in 2022 was close to, if not exceeding, 60 to 70 billion US dollars. Now, what we do have as far as publicly traded companies go, again, with Adyen, we have seen the resurgence of their stock's performance because the prior concerns was that Braintree was taking market share due to them offering the product at, let's say, maybe even a reduced take rate to that of Adyen. And so Adyen had to compete in terms of quality of their offering because they claimed, at least management said at the time when the stock price was suppressed, that they weren't going to stoop down or lower their charge for their services, that they believe they had the superior product. Recently, last year, with the report from Adyen in Q3 and around Q4, we saw the resurgence of growth from Adyen, and therefore the stock price actually reacted quite nicely there. Now, PayPal, on the other hand, has been quite suppressed. The stock price now is hovering around $60. And with this discussion in particular on CNBC, the stock price did have a little bit of a bump upwards to about $65 a share before falling on the day of the announcement. I'm going to showcase that for you guys here. So we're not going to watch the full thing, but I'm going to skip through some of the parts here and kind of see if going off the illustrations. So in effect, what they announced was lowering the time at which a customer, a user of PayPal, can finish a transaction. So increasing the speed, which I think it was already quite fast. I'm not a diehard PayPal user, but I've used PayPal here and there for some products online, and it seems already quite fast. One of the other things that they announced was the addition of advertisements that are going to be placed on the receipts. They bought the company, I believe it's what is it called? Lemonade? No, not Lemonade. There's one of the online coupon businesses that PayPal ended up buying, and they're utilizing something similar to that to offer additional cashback or discounts to some of their clients. And this is a way for medium or small size businesses to kind of put themselves in front of another customer that potentially bought a similar product. This is very similar to when you go on something like an Amazon. Honey, thank you, Lincoln. I was like, lemonade, something like that. Honey and lemonade. That's why. So it's very similar to when Amazon, when you buy something on Amazon, Amazon knows that, okay, this person is trying to buy a blanket. They might want a pillow with that blanket. So they say, might also want to check out this product. And someone is paying to be in front of you in that instance. So PayPal is trying to kind of emulate that strategy, and it could do well for them. But although this is not what I think investors were expecting. And by the way, as people are rolling in, feel free to answer that poll I have for you, because that's, gonna see what the results were. And then I'm gonna try to see if it's more or less how I'm feeling. So I'm purposely not looking at how the poll's doing right now. Now, PayPal, aside from this, has been trying to, let's say, or the CEO has been trying to drum up this sense of growth at a reasonable, let's say, pace. So focusing on profitable growth. That's the terms that he's used. And of course, this individual, he comes from Intuit. Now, Intuit is one of the 100 baggers, a famous 100 bagger. So if you've been an investor in Intuit, which is probably very few, if not any of you, since its IPO, you've done extremely well, but you don't have to have invested at the IPO to have done well. Just kind of, if you pull up, let's actually pull up the share price. So Intuit stock, just to kind of show you guys how insane the returns have been since the beginning. So if I max this chart out, you can see the total return has been 24,102.26%. And that's not the total return. That's just the price appreciation. But if I pull up the Investor Tech Day presentation, so the which was posted on January 25th, the one that we were seeing him discuss on CNBC. Let me kind of zip through this. This is what I was going to show you guys. This cashback, so additional cashback that they were going to offer on top of it. Now, I don't know how exactly this will work, but it seems to work similarly to how banks offer additional rewards. I saw a bunch of YouTubers kind of also say, because you guys have sent me clips as the week went by, some YouTubers kind of also questioning themselves like, oh, how is this cashback going to affect them, or where they're going to get it from? From what it seems to me, and I don't have the details, if you guys go on your banking app, you'll see that somewhere it will say, and I'm speaking for Americans, by the way, I have no idea if this is offered by European banks, but you'll see somewhere down where it says rewards, additional rewards, and you click that. And if you're on Bank of America, Chase Bank, pretty much every bank has it, you'll see additional merchants forming some sort of partnership or agreement with said bank, in which case you get additional rewards. Oftentimes it could be like 10% additional cash back, $5 off, $150 off when you spend $30, things like that. And that's one way for merchants to kind of partner with the bank and say, hey, we're going to drive additional sales. We're going to give this extra discount to your customers. So that's not necessarily new. That's something that banks have done for a long time. And if you're a credit card enthusiast or a credit card churner, you're already really familiar with that. And heck, even American Express does that. So I'm saying this is a very common benefit that you receive. Now, again, it's probably not going to be at every single place, because the way it made it sound is it's at certain merchants you're going to be getting this additional cash back potential, because it's supposed to drive sales. It's a let's call it sort of like an advertisement. It's promotional. Now, the other form or the other stuff that was said is more so along the lines of setting a goal of innovation. And I get it, because I would hope so. Every company should say that they're going to be innovative. They're going to drive sustainable growth. One part that PayPal CEO said that I picked up on in this interview, I won't play it, just kind of watch it for yourself, or just trust me that this was said. He said that some business lines that they were previously involved in, they might not be involved in the future. So I started thinking about that and saying, what could that be? One thing that probably came to mind for me is the buy now, pay later. Maybe they're not going to get involved in that, because that's definitely not Braintree. He's not talking about Braintree there. He's not talking about the legacy checkout. He's not talking about Venmo. Maybe he's talking about buying and selling cryptocurrency. That could be something he's discussing there. I think more along the lines of he's thinking about the part where you're doing a buy now, pay later. That might be the case, although I'm not so certain. Companies like Affirm have actually done quite well in the past, let's say, quarter or so, price wise, business wise. They're just growing. I haven't really looked too deep into it to see if the reality is changing, or if it's just exuberance in this current market, which we will be discussing a little bit here in the public live stream, and we'll be discussing a little bit more extensively in the private live stream after this, because we're going to be discussing a little bit more of a not macro focused discussion, but there's going to be some discussion around that, and also around bonds, but we'll get to that. So Amazon has been having one-click checkout for years. Yes, that was the other product that they did announce, the one-click checkout, which, thank you, Gil, for saying that, because that was another point I wanted to share, is that something like Amazon, on top of having the, oh, you might also like this feature, they also have the one-click checkout, which I use all the time. It's very convenient for me when I have a product that I want, and I just click one click, and then boom, it's going to be delivered to the property that I want. Okay, so I need a cope later. I'm investing in PayPal so I can join. Oh, well, I mean, you could do worse. And that's what I said to the individual who may or may not be that person in the chat way long ago, when they were saying that, watch out, PayPal is going to be this and that and this and that, which I'll be discussing a little bit about the narrative around PayPal. And again, going back to the broader theme of today's live stream, which is what kind of makes a business that's a true compounder. So I think that a lot of people that are really invested in the PayPal story are, and I've said this before in prior live streams, so I'm kind of repeating this point, but it's really honing in on this topic. I think those people are people who missed the meta boat, and in a very meaningful way. Maybe they caught towards the end of it. Maybe they just only put a little bit of their portfolio in, and they're seeing PayPal and they look at the chart and they're like, this is the next meta. And I've heard people even say that verbatim. This is the next Meta. A lot of the YouTubers that are, let's call it the hypesters on YouTube, they're not too big. These are not necessarily the biggest channels. Some of them are smaller channels that focus on fintech. They literally attribute this or compare it to the likes of Meta. And it's, again, it's because they missed an opportunity like that. And so they're kind of utilizing this company as a sort of FOMO, which, again, it could do well, but you want to be very careful with making those comparisons, especially if they're completely different businesses. So something like PayPal versus something like Meta, completely different businesses. So you need to just be a little bit cautious or wary when you're making such a comparison. But now, coming back to it, you could do worse than PayPal. There's definitely worse companies out there. This is more of a story where you have to have some form of maintenance in the core business. And if you have that maintenance in the core business, followed by growth in something like a Braintree, and let's say you carve out, I don't know, roughly 30 to 40% market share in Braintree among enterprise, you could maybe do better, but you're taking up that market share with Adyen. There's a story here. There's something here. And I've done valuations of PayPal in the past. You can go check out my videos, and I stand by those valuations. But it's not an easy story. This is not something that I look at and say, I would really like to put tons of my capital into this because I think this is an amazing opportunity. I think there are other better opportunities. Frankly, the only reason why we even discuss PayPal here on the channel is because it's so talked about by retail investors, and by proxy, because I am commentating on a platform full of retail investors, I am talking about PayPal. And so if I was discussing this, very seriously amongst, let's say, a group of individuals who our goal is to maximize returns, I don't think I would even bring up PayPal in the conversation, on a consistent basis. It might be the topic of the day, the flavor of the month, maybe. But as far as it is now, it doesn't scream to me that it's the greatest opportunity that I've ever seen in my entire life. I've seen opportunities that, in my opinion, and I'm saying in my opinion because even though I have hindsight, I'm just kind of talking or describing how I felt at the time, and I put the money where my mouth is. With regards to both the holding co and my personal holdings, and you guys know which stocks those were. Okay, so Meta's different stock recovered mostly because they cut costs and got more fit with less spending on metaverse. I disagree with you. So I disagree with you wholeheartedly on some parts, but I get what you're saying. So the metaverse spend was never the issue, although it, for whatever reason, drove the narrative. The metaverse spending was still a small proportion of what the CapEx actually was. And this is a very common statement made by a lot of investors. So you can even go back to watch my really old video. I just don't make tons of videos again and again and again of stocks that I've invested in, even the ones that are, let's say, big successes. Although arguably one would say you should do that because that's how you grow on YouTube. But I haven't. And you can go back and just watch that video because I think it's still pertinent to today. And it was published in November of 2022. And I think it's titled, ironically, by the way, it's titled Meta is Uninvestable, Broken Trash. So just go watch that video. By the title, you'd be like, oh, this is aged poorly. But if you watch the video, it didn't age poorly. So I point out that a lot of the investment isn't necessarily the metaverse. It's actually just CapEx for their own hyperscaler internally that would give them a huge cost advantage and should, in theory, if worked out, hindsight it did, produce tremendous amounts or help them produce tremendous amounts of cash flow margins in the future. So let's see. Well, that could be a coincidental. He's 40% of his net worth in PayPal. Yeah, I mean, it could be, but the thing is, you could pick a worse stock than PayPal. I just don't think it's the same opportunity. Okay, so Venmo is still fairly common. I guess you're saying how popular Venmo is. I would agree. Venmo is still pretty popular, although I see a lot of people around my age or younger using Cash App, not Venmo. Although back in the day, at least my college days, there was a lot of use of Venmo, and then Cash App was kind of on the up and up. Now, when I go to, let's say, I don't know, random places, they take the preference of the individuals I've spoken to has been Cash App. I don't care of either. I prefer Zelle. If anything, I have a good banking relationship. I kind of stick within the banking network. But on occasion where I meet someone that is underbanked or doesn't like to use a bank account for whatever reason, and they use like debit cards instead of, because I don't use debit cards, I use credit cards. Oftentimes they'll like say, I take Cash App. Yeah, I use Zelle also. Yeah, Zelle's amazing. So, okay. How's Meta's different 12 months ago versus today that changed the narrative? Financials seem mostly the same. In what way? In what way are they the same? I would argue that it was all a temporary blip, and all that the people were shouting from the rooftops was, I don't know what report they were reading. We were reading two different reports. And then I think that's what really contributed to my confidence was people were seemingly reading the same report and coming to a completely 180 conclusion than myself. And then I wasn't alone entirely within the club, but for the most part, it was hold your nose moment. Then I got better because of Zuck. He just challenged his workforce by cutting and spending the message. No more BS. Well, that's all big tech. That's all big tech. And that's if you don't work in big tech, which I don't work in big tech, but I'm aware and I know people who do work in big tech. One of the things that is a general unspoken policy of big tech is to hire more people than you actually need. So you reduce you basically have all these qualified engineers that sometimes are doing nothing so that they're not working on competing products because you have that kind of money. And that's kind of a flex in a way. Do you think that the secular decline of PC usage will hurt PayPal over time as web browser checkout slowly does worse compared to Apple and or other mobile payments? You see, I didn't even think of it that way, but that's a really good point. And that's true because the times I think about utilizing PayPal is often when I'm not on my phone. It's often when I'm interacting with the merchant through my personal computer. And I can think of all the times that I do interact with a merchant on my cell phone. It's pretty much all through apps or applications or within, their own stores. And oftentimes, you have Apple Pay checkout. Apple Pay checkout is way more convenient. In that case, it does the exact same thing, utilize my credit card, etc. Actually, I wouldn't say it's more convenient. It's just the same. It's the exact same thing. Apple looked at what PayPal was doing and just said, you know what, we can do that too. Here you go. Just make it and throw it in there. And then other big tech players like Google also did the same thing on the Android platform. So when you have, your Android phone, it's just like, okay, we can do it too. Here you go. Whatever, nothing special. And it does effectively the same thing. So it's not more convenient. I think it's just the same. You could argue maybe it's more convenient because it's not an additional app you have to download. It's not an additional account. You kind of have to log in. It's just connected to your phone. So why did the Venmo Amazon deal fall through? Likely because Amazon looked at it and said, in this relationship, we have technically all the power. Our network effects are much stronger, and Venmo takes too high of a cut. Now, something that the CEO did discuss when talking about or commented on the loss of Amazon or Venmo's loss of Amazon, he discussed, and I think this is good to kind of say as a CEO, saying like, okay, we have to value ourselves. We can't, lower our costs too much. We have to maintain a certain price points because again, if you're going to take him seriously, he stated that his goal was to grow profitably. All right, so that language is in line with that prior goal. So I kind of have to put my thumbs up to that because it's consistent. But the reason why they lost is because Amazon was looking for ways that they could make slightly more margins. And when you're dealing with such high payment volumes, such as on a platform like Amazon, any small percentage, while to us seems small as a percentage, for Amazon, that does make a large nominal savings amount. So I'm PayPal bearish. I feel like it's a race to yes, that's exactly the language we used on this channel. This industry is a race to the bottom. Every business is trying to figure out how can I offer the same service for less so that I can just grow with volume. And so something like a PayPal exists. Another competitor comes in and says, we'll do the exact same thing, but we'll charge you less. Come with us, and then we'll try to take more market share that way. And then a new one comes in after that, et cetera, et cetera, et cetera. Or in this case, I think another example is that there isn't really something that prevents another player from replicating that same network or that same product. Something like a Visa and a MasterCard are, simply put, just the actual Modi fintech businesses that we actually probably all interact with on a daily basis globally. And that's actually difficult to replicate. So PayPal even operates on the rails of Visa and MasterCard. And the banks all use Visa and MasterCard because they're really good and trustworthy intermediaries that allow the payments, for example, the credit card when they extend you credit. Of course, when you talk to someone on the street, they often think that Visa and MasterCard is the credit card they're using. That's not true. That's just the brand of, or the type of we'll call it the rails that the payment is going through. But really, the credit card belongs to the bank. The bank is the one extending you the credit. Visa and MasterCard have no, let's say, credit risk. And something like American Express has a different approach where they control the full relationship all the way through. And they also control the rails as well as extending you the credit. It's a little bit different. Will Amazon quietly eat the world? No, not at all. So Amazon is competing in a different way. So Amazon is attacking many businesses, but not every business. If you look at Apple, there's going to be some overlap, of course. For example, I think with the personal assistants, there's huge overlap. You have Alexa and Siri. I don't want to, make any of my devices like wake up, but you have Alexa and Siri. You see, there you go, risking it again. And the in that way they are competing, but Amazon's not. They've already given up on getting into something like a personal device. And for the time being, for example, Amazon's not getting into augmented reality headsets anytime soon. But then you have Meta overlapping with Apple there. And then, of course, you have Alphabet there trying to do a bunch of other things as well. That, let's say, you look at Amazon. Amazon's not trying to get into driverless driving, so full self-driving. They're not really trying to create a product in that category, but Alphabet is. Apple is as well, it seems, and they're a little bit quiet about it. Although, if Amazon is also working on it, I had no idea, and I didn't even put that in my thesis. I don't even plan for that being successful. And then we have Amazon getting into robotics, but Apple, as far as I know, again, this could be the case, and I just have no idea. Apple is seemingly not going into robotics. Meta is going somewhere adjacent into some sort of sensory prosthetics, which could be used in a way for robotics, or at least robotic prosthetics in the future, which is interesting how that could do. But what I'm getting at is Amazon's not in literally everything. They're just in many things. And some of the things that they're getting into, they're becoming one of the top players. One thing I did want to update, this was going to be when I did a Netflix video, because I do want to get into that. Welp to go to the hospital. I don't know, Welp to go to the hospital. Do you need to go to the hospital, Fuhat? Wish you luck. Okay, good luck, Fuhat. Godspeed, my friend. Okay, so when you look at Amazon, their Prime Video is stepping up quite a bit. They've actually, I think they're right now, according to recent Nielsen data, they're right under Netflix. So there's YouTube, Netflix, and then Amazon Prime, followed by Hulu plus Disney Plus. If you combine those together, they're still above Amazon, but separately, Amazon is above Hulu, and then Disney Plus is below Hulu. But when you combine them again, it's much larger. And then unfortunately, HBO Max and what's it called? The Paramount together, they're still really small. They're trying to merge right now, but if you see what they'll be after the merger, if you just combine those figures together, they still don't even match up to the top players. They're so far away. It's unfortunate. But okay, so let's see here. Serious question, maybe a good popped question. Who would you bet on will be more successful, Meta or Apple in the metaverse? Okay, so if Meta is successful in the metaverse, I don't think that's priced in, but I think Apple almost has to be successful in the metaverse because in a way, their technology, they rely on controlling the technology that we interact with on a day-to-day basis. If that is pride from them in any way, I think that spells really bad news for Apple. So Apple can't afford to fail in the consumer electronics segment. They have to be always, and it relies on something like this, which is, oh, that's funny that it's fading around the green screen, but you can just trust me that this is an iPhone. And Apple relies on having the control over this product that I use on a daily basis. Now, if there's a new device that comes around that I use more on a daily basis than this phone here, then that spells trouble for Apple, because then they lose control of the customer, and there's all the other ways that they make money from me as a customer through this product, not just the sale of the product itself. And that would hand over a bunch of control to whoever it is that takes over that role in the future. Now, to say that it will always be Apple, I don't know. I don't know if that's the case. I don't have the crystal ball, but I would say that because probably Apple knows that they have to win, I think they're going to try really hard over the next decade or so. And then I think Meta with Mark Zuckerberg, I think he's really ambitious. He's got the drive and he's going to have a go at it too. And he thinks he can do it. Let's see who ends up on top. In this case, I think Meta doesn't necessarily, and this was part of the thesis when we first invested, the metaverse doesn't have to actually play out. Meta can do just fine under the current reality of the world. Then it's if the metaverse works out for Meta, then there's certain things that are not priced in, I would say. Okay, so I think that kind of covers the gist of what we're going to discuss with PayPal. And let me go ahead and close up the poll. So far, the results of the poll, and I'll give actually you guys 5 more seconds to vote in the poll. Also, if you're liking the video so far, feel free to leave a like. And if you're not subscribed, go ahead and subscribe. So far, and I think that covers about that 5 seconds, we had, did PayPal shock you? We had 6% answer yes, 65% answer no, and 29% said yes in a bad way. I kind of almost count that as a no, but it's like a harder no. Okay, so the vast majority of this audience seems to have not been surprised or shocked by the PayPal events. Some of you are, lesser than shocked. You're disappointed almost. But yeah, so that is pretty much in line with where I was at. I didn't watch the results of the poll until after I got back on here on YouTube and closed it off. So kind of seeing that we're kind of in the same agreement. It's not a phone that is needed, but people need to actually compare Android to an iPhone and realize that it's not needed to overspend just so you can pay an Apple tax. But yeah, well, for me, I don't know. I get it. You Android is cheaper, et cetera, or you can get a lot cheaper products with an Android. But for me, it is a bit of like a trap. I'm trapped in it. You got to help me out, man. You got to help me. Do you see Apple double from here to get to 6 trillion market cap someday? I don't see a path. I don't see a path, but that doesn't mean that it can't happen. That's the problem, right? So I see that Apple's growth is stalling and it commands a really high multiple. So a lot of the gains that Apple has experienced in the past decade has been through multiple expansion. So ever since Warren Buffett bought, you saw the multiple just continue to expand and expand and expand. And now we're seeing a 30 handle on Apple, and where it was previously in the mid-teens. So a lot of the return has been through multiple expansion, not only through growth. And of course, they've bought back a ton of stock and reduced the float, et cetera. But really looking at it, there's a lot priced in. I don't think that it's priced. I do think that it's priced for perfection in some ways. I think it's priced for a certain story playing out, and the setup is not appealing, similar to other stocks. So let's talk about Tesla. And again, continuing on with the theme of what makes a great compounder. So Tesla has done really, really well in the past, at least since 2019. But ever since it IPO'd, it's done really well. So if you've for someone who bought Tesla when it first IPO'd, you're not complaining. You're really happy with yourself, and congratulations. I'm really happy for you too. So Tesla is, needs no introduction, electric car manufacturer, the #1 electric car manufacturer in the world. I'm going to start by saying, I have people that I contribute with, and the beautiful part about this community is we have sometimes different viewpoints, and I don't consider myself that I don't like the company, although there are some things that are always questionable about it. I completely agree. When, for example, we have Dan Weston and Bacon Beams on, they like to point out, and it's super true that for example, in the last live stream, I did not know that the Porsche race was actually a little bit misleading. I had no idea. And so learning that was really interesting, and also important to kind of reflect on and say, wow, okay, we have to be sometimes very careful with what Tesla markets at when they do market. And of course, it's more or less known that the range sometimes is a little bit exaggerated in some of their products, like, for example, the Cybertruck. Now, but all that being said, I do also say that Tesla, and this is my opinion now, I'm just stating opinion, Tesla, I think, is the best current offering for electric cars. I think that if I look at what is offered by any other car manufacturer out there, I think Teslas are the best. And I have owned 2 Teslas in my past. Currently, I don't own a Tesla. If you guys didn't know that, I got rid of my Tesla earlier this year in lieu of another car. You guys can guess what car that is, but that's not the point. The point is, when I looked at Tesla and I compared other offerings by other manufacturers, I looked at the Ioniq 5, the EV6, which those 2 were actually quite nice. And honestly, were something I could have seen myself get as well. But I also looked at the Polestar 2. The Polestar 2 was good interior-wise, quality-wise, but some things were lacking, like range. And, there wasn't that... actually, the acceleration was fine on the dual motor, on the all-wheel drive one. But if you actually looked at, and this is different back then, it sort of changed. But right now, I'm talking about right now in today's reality, the Tesla vehicle is actually very affordable. You get a lot of good car for a comparison, because I have to be careful with this, compared to these other electric car offerings. Okay. That using that comparison, because you can start comparing it to some ICE vehicles, etc., even including and we're talking about new, because of course you could get the ones from Hertz used for like 15,000, after the credits, and good luck to you if you do that. Be careful. But looking at new versus new, Tesla right now is actually quite compelling offering if you're hell-bent on an electric vehicle. Okay, so if you really want an electric car and you're looking at what everyone else has to offer, they all offer pretty subpar products to Tesla. Now, some of them have things that are better. So, for example, let's take a look. If you look at Audi, Audi has the e-tron. The e-tron car, the interior is probably higher quality. The e-tron car, of course, is a $104,000 car, so you can't compare it against the Model 3. If you're doing that, I don't know what you're doing. But if you compare it, for example, to the Model S Plaid, well, the Model S Plaid is going to cost you what, 80,000, something like that, and you're going to spend 100,000 for like a base e-tron. I'm talking about the sedan e-tron. So when you use that comparison, then you're like, I don't know what you're doing buying the e-tron. The Tesla Model S Plaid's way faster, better range. Honestly, interior, I like aesthetically the Model S Plaid versus the e-tron. I like the minimalist design. I have an appreciation for it. I do like other car designs too, and if you're kind of going to spend like $100,000 for interior quality design, I mean, there's plenty of other cars. This is if like you have to have an electric vehicle. I mean, you're kind of just paying for badge at that point. I don't know what to tell you. And then it gets worse when you go into Porsche, right? When you get to the Porsche electric vehicle, it's like, what are you doing? When I went to the dealership, I said this the other night in one of the club voice calls at nighttime. It was funny because they were telling me like, we can't even get rid of these things. They were discounting them like crazy. And because no one wanted them, because the Porsche enthusiast drivers don't want to buy an electric vehicle. Because, by the way, if you didn't know this, electric vehicles, when you drive them, they kind of more or less all feel roughly the same. So like really what you're going for with an electric vehicle is more so the fun factor. And if you don't have that fun factor, there's not really that much of a point. And what I mean by fun factor with an electric vehicle is the fast acceleration as possible. That's like the fun factor with an electric vehicle. So that's all to say that I have this, I look at Tesla as being the best electric vehicle offering today. I don't think necessarily I can say they're the best car company per se. I think that still has to go, and I say car company, to something like a Toyota, but Tesla has really made ripples in the industry for sure. And they can become the best car company in the future. I don't know. Now, looking at also the commentary I have for you on full self-driving, because I also utilized full self-driving when I did have my Tesla, and it was pretty good. It was pretty good. I didn't really have any complaints. It's not something I would trust and like go to sleep and stuff, but it was good for when I used it. And it was very useful at times when you were kind of a little bit tired, you didn't want to drive, and you could just go to your destination in your car. And I would test it. It could navigate neighborhoods pretty well. Of course, kind of always like, oh gosh, no one jump in front. I don't want to test its capability of stopping. So, I'm using it actually, by the way, as it's intended, because it's still in beta mode. You're supposed to be paying attention. One thing I did notice, of course, is the insurance rates. My insurance rates went down right now for a car that you would think would have more expensive insurance rates. And I got a refund from the insurance company. And So it was funny because I was talking to the insurance person and they say, oh, we're going to give you a $200 discount. And I was like, oh, that's very strange. It's like, yes. And, you know, one thing that I did see is that Tesla insurance, which is not offered in my state, is supposed to be cheaper, but there's a caveat because it's cheaper maybe in like the first couple months. And for some people who've used it, they've said that it increases later on because of course it's watching everything you do. And from my understanding, not myself, because I frankly, when I had the Tesla, I kind of drove it like a grandma, like literally I would make it drive most of the time. But it drove as it was meant to be. I would not have like sudden stops, one pedal driving all the way. Getting used to non-one pedal driving again was well, it's not really something you get used to. You never forget, you know, regular driving. But anyways, getting back to it, Tesla as valuation is a completely different discussion that you have to have. And then the question I have here is Tesla a cult stock? And I think that when you see that any form of discussion that is against Tesla gets attacked with quite a bit of aggression, you know, it's tough to say that it's not. Because if you go online and you say something negative about Tesla, you do get a lot of pushback. And then I do agree that I think sometimes there's almost the feeling that there's a lot of people also against Tesla just because it's Tesla. And I get that. And I've heard some people make the other argument on the other side saying like, well, we are aggressive because the other side just like really hates Tesla. And I don't agree with that. And that, you know, there's got to be like a counterbalance. I hear you. And then the other side is saying, well, if there's people who are like foaming at the mouth for Tesla and they almost like they have tattoos of Tesla everywhere. I get that too. And I see it. I see that one actually more, if I'm being honest. Because of course you do have like the Tesla Q guys, the people who are saying like Tesla is a bankrupt company. See, like that's where they lose me. They lose me on that a little bit because I'm like, okay, there's an argument here, but you know, hey, let's be honest about the argument. Because a lot of the issues with electric vehicles is electric vehicles, but sometimes people say this issue with electric vehicles, well, it's just Tesla, and it's like, well, no, it's not just Tesla. It's also like all the other electric vehicles too. And one thing I'll say is that like other car companies, like, you know, Toyota Motors is something that I think Dan has a video on. Dan Weston, he has a video on this that they've been working on the solid state battery technology, which seemingly is going to be the battery of the future. Not that Tesla isn't also working on that. And of course, we're going to get like cheaper versions of batteries here soon, that sodium powered batteries that what's that Chinese company? BYND has been releasing in China, and I think they might be releasing here. Basically, these lesser quality, more affordable batteries, a little bit more unstable potentially. You know, that's kind of trying to address the affordability problem historically with electric vehicles. So we're going to get there as a society where electric cars are going to be a lot more affordable than they are today. As it stands today, you know, electric vehicles still are the aspirational vehicle for some. For others, you know, it's they like it. They really do like it. I'm one of those. I think I do like an electric vehicle, although I also have an appreciation for certain ICE vehicles. And, you know, I think it's about your taste. You know, there's no wrong answer there, whatever you like to drive. But kind of getting back to it, the overarching narrative here, Tesla, cult stock, I think so. I think I have to say that it is a cult stock. And another thing that I find, you know, undebatable is that the amount of new investors that come into the market and say, hey, what stock do I invest in? And they kind of just merge and go towards Tesla. It's quite evident. And unfortunately, for a lot of those newer investors, not all of them, because there are plenty of investors, not plenty, but there are definitely investors out there that were really early into Tesla, and they've done really well. And of course, they probably have that bias. Like it's kind of like how I tell you guys, where you know, I say that just because I've done well in the past doesn't mean I will do well in the future. And I am also aware that my past performance is affecting my bias and kind of my mental process of thinking about how I'm going to invest in the future, saying, okay, I'm going to continue to try to invest in individual companies to try to see if I can continue some sort of performance. Because if you had long years of underperformance, you would hopefully think that you would get to some point where you'd be like, okay, definitely not working for me. Got to do this. But sometimes it's also like survivorship bias in a way. So like you survive this long, so I'm going to keep going. Same thing with like Tesla. It's worked out so far well. It must keep working out well, and I think that's what's going to kind of surprise a lot of people if they're not careful. When you hit midlife prices, would you buy a Ferrari? No, I don't think I'd ever be able to justify the spending. I'd have to have a ridiculous amount of money in order to buy a Ferrari, like a ridiculous amount of money. More money than I think I'll ever get to. I'm saying ridiculous because a Ferrari is now, it's not just buying that one Ferrari, because you can't just buy a new Ferrari, the one you want when you want it. Because probably if I want to buy the Ferrari that I want, I will have to buy, the Ferraris that don't sell, have that for a certain period of time, maybe buy a couple more Ferraris that I don't want, and then eventually get to the Ferrari I do want. So you see, like, in order to, really enjoy and get the car that you want, you have to have a ridiculous amount of money. Because it's not going to be, oh, I'm just going to walk into Ferrari tomorrow and just get the car I want. Doesn't work that way. Okay. So let's see, Tesla's a preview of what's going to happen to NVIDIA. Okay, so we can talk about NVIDIA, but now let's go into like the compounding story. So Tesla has done something that I think is quite remarkable. They have basically been able to take advantage of the exuberance in their share price, and they put themselves, financially speaking, in the best position of any car company out there. So if you actually look at Tesla's balance sheet, and I think a lot of Tesla bulls are pointing this out right now, saying, look, Tesla has all of this cash, and look at their debt compared to their cash. Exactly. Better than everyone. And now, while I want to also caution you, I have a video on this. I can do a new video on it in the future. But the debt you see on Ford's balance sheet and some data aggregators, be very careful and suspect of that. That's actually not the actual debt. It's like there's the corporate level debt, the financing arm debt. You have to separate the two. Tesla doesn't have a financing arm, so they just have corporate side. They've partnered with banks. When I bought a Tesla, the first time it was still Wells Fargo, and then the second time it was still Wells Fargo. So they partner with banks like Wells Fargo. I can just tell you it's Wells Fargo. And they take on the financial risk while Tesla just focuses on the actual selling of the cars. Some other companies like Toyota, like Ford and company, they have a financial arm that does a lot of the financing deals for them. And so they take on the additional financial risk, not just the normal business risk that they have just being a car company. So looking at Tesla, they've taken advantage, and they've also been dilutive, which, by the way, if you're an investor in Tesla, you should be happy that they're doing that. This is not bad, because and again, if you think that the stock price is cheap, you should be upset. You definitely should be upset. Okay. You don't want dilution when it's cheap. You want dilution when you're expensive, because a business has to, and this is true of any business. If you're running a private business, if you're running a publicly traded company, no matter what, the rules don't really change. You're focusing on what is the best way to raise capital at the cheapest cost. And that could be borrowing money. So in the case of, where I'm working now, we might look at, okay, what's that line of credit going to be? What is that bank going to give us? What is that bank going to give? So you compare across lenders as one way, and then you look at what are some options to raise capital. Can we raise capital by putting up some collateral, and what is the rate there? In the case of Tesla, because it's a publicly traded company, they have, of course, the debt markets that they can go into, but then they also have, of course, their own shares, right? So their shares has a cost, and it's a bit more flexible, because when you sell shares, you don't have a time stipulation. You might have heard me say that in the past, like a contract has a time stipulation, a bond has a time stipulation, a loan typically has a time stipulation. A share has no time stipulation. It's very flexible when you have to return capital. There's still a cost implied, because you're giving up future earnings. You're giving up a portion of future earnings, but you're gaining a ton of flexibility, because when a company issues those shares, there's no requirement for the firm to make good on anything, right? It's just shares. Now, all the existing shareholders, now they have to split up the equity, the earnings amongst the new shares that have been created. But Tesla has done this in a really smart way. So they have been diluting while the share prices were elevated, and that was helping them fund their CapEx. Something that the other car companies seemingly have been struggling with a little bit, because they are in a less bountiful capital position than Tesla is. And Tesla, taking advantage of this elevated stock price, did the smart move. Bobby's about to explain weighted average cost of capital. Now, we're not going to go too deep in the woods there, but yeah, you can get into that to try to explain why a business internally wants to basically try to minimize or lower their weighted average cost of capital as much as possible, and then use that as a barometer for future projects. But isn't this a sound a duck makes? Well, I'm a Scrooge McDuck now. Oh, whack. I get it. That flew over me for a second. Debt is tax deductible and doesn't dilute. Why do people ever celebrate equity issuance? Well, the reason why I just said you do want equity issuance in the case where you do have some advantages. So there's not a disadvantage only. The main advantage is flexibility. Because if you utilize the other forms of leverage, a lot of times you want to be careful how you spiral down that direction, and then you get caught up with certain restrictions that debt might put onto you. Because in the case, like some debt that you'll take on, if you get to a certain quantity, they'll put like restriction on how much debt you can take out further. And you want to just be overall cautious. No company has gone bankrupt for not having any debt. Right? Debt is the number one cause of financial turmoil in a publicly traded company, in privately owned companies. Debt is the number one issue. So Tesla, if your stock price is really elevated, your cost of capital there, your cost of issuing stock, let's call it like an earnings yield. Let's say your earnings yield is like 2%, but you can borrow at 7%. Why are you going to go out and borrow money when you can just issue stock currently at 2%? Now, let's say an earnings yield, and I'm oversimplifying this, by the way, it's not actually that simple. Now, let's say my earnings yield is 7%, and then I could borrow at 3%. Well, yeah, if you're issuing stock, then I mean, I don't know what you're doing. Maybe you have a ton of debt. Maybe your earnings yield is really high because you're already kind of bloated, and the debtors are willing to still lend to you because your credit rating is still okay, and you still have enough assets that if you liquidate, they'll be fine. Maybe that's why your credit rating is still fine. Again, oversimplifying it there. But going back to it, Tesla is, yes, I'd say in conclusion, it's a cult stock. Is it a compounding stock? I would say that it has some attributes in there. What are some attributes in there that kind of make it a compounder? Well, it's getting into different businesses that are not too far away from its main business, which, electric vehicle batteries. Okay, well, we can get into energy storage. That seems like it's just adjacent to it. Now robotics, that's starting to get a little bit away from it, but I'm not going to fault them entirely for it because, Amazon kind of also is getting into things that aren't necessarily within its traditional realm of competence. But hey, you have Tesla robotics in there. We have to just see what happens. But I'd say Tesla energy, that makes sense for Tesla to kind of get into there. And if they're really successful there, then, hey, you have another business that could, derive a lot of value for shareholders. I think what's really exciting for Tesla is the fact that they got GM and Ford to capitulate on the charging. That's actually a lot bigger of a deal than I think people realize, because now you're going to have other cars making their cars have the charging ports that Tesla can then profit from. Now that's kind of like owning in some ways like a gas station. And then Tesla has all the gas stations basically. And that could be an interesting source of income down the road. This again is further benefited by more EV adoption. So we have to see a lot more EV adoption, a lot more people buying Ford electric vehicles, General Motors electric vehicles, and we got to see if there's other companies that adopt that as well. Another kind of thing that's interesting about Tesla, of course, is not just the let's say the electric charging stations, but the full self-driving. So this is where I think people kind of lose it, because I disagree with Tesla's ease of licensing out full FSD. I used FSD. I think it's a good product. It can get a lot better, and it will hopefully get a lot better. But there's a lot of problems that come with FSD. So one problem number one that people I think ignore. And people get mad when you point this out. This is again how you kind of know, you start to say, am I in a cult? You look around, you're like, everyone's going like Tesla, full self-driving, a future. And then you're just like, maybe. maybe I'm in a cult. I'm gonna see if I can ask anyone here if they disagree with me, and then someone disagrees and then like boot them out or something, or they yell at them. But again, I'm not speaking that that's every single Tesla bull, but I think that's a lot. And I think that's more of, again, a proxy of the newer investor getting into this. They kind of attach themselves to the stock, and they do one of the newbie mistakes is attaching yourself to a single company. Okay, but going back to it, full self-driving, licensing it out to other car companies. I think there's a huge problem there. Okay, the problem that I find with full self-driving, licensing it out, is you are a competitor to that car company. And I've been saying this with other companies before. One company I've talked about this in the past was SoFi. So SoFi is reporting earnings on Monday. So we're going to see how Galileo and Technesis are going to do. Now, I have a video live stream actually in Q2 of 2023 discussing SoFi. Again, I don't make like tons of videos on SoFi update, blah, blah, blah. No, it's just like once in a while we'll do one, maybe once a month at most frequent, but that's definitely not so. SoFi is like, I think I think we did like 3, I can't remember. Videos, probably not that many. So point is, one of the key points of that live stream was SoFi's tech platform. It's going to be difficult for them to grow, in my opinion, because, and this is before we got the numbers, because they are also competing with their potential customers. And so if there is another competitor that offers a similar product, maybe you're better than them. Maybe you are better than them, but you're not that much better than them. So if I'm, you're pitching to me and you're saying, hey, use my product. I compete with you, by the way, but here, use my product. I can solve these issues for you. And this other guy comes in, I don't compete with you. I can solve these issues for you. Maybe I am 10% worse than the other guy. And let's say you're in an industry part where 10% isn't that big of a deal, because that's an oversimplification, because maybe 10% is a huge deal. Maybe let's say to be more accurate, it is within a margin of error or difference that is not materially significant to the business. Okay, so whatever that is. And then that's going to be a very tough sell to your competitor that you want also to be your customer. And I'm thinking, for example, they have competitors that are customers, like Robinhood. Robinhood's a competitor. How are they competitors? Well, Robinhood has a brokerage platform. SoFi has a brokerage platform. They compete for assets under management. And by the way, they have a lot of overlap in their customer base. They're targeting roughly the same kind of consumer, which I would argue is not really the hyper wealthy individual, maybe newer to investing, and younger crowd. They're both targeting that same person. And because I think what do they call themselves? Wealth, not yet rich. What do they call the people that SoFi targets? It's like high income earners, Harry's, something like that. Harold's, like basically high income earners that aren't rich yet. That's what they say they target, which I kind of have my doubts about. I get that you have like student loans that, you're getting that relationship with that medical student, and okay, that person's probably gonna have a high income earner eventually. But I don't know if that they're gonna say, oh, I'm gonna just stick with you because why not? I have this bank relationship. When they're gonna have that, if they have a good amount of money, that's when the banks start to kind of call you and be like, hey, you want to come and we'll give you all these things. And I'm telling you, some banks offer you, sorry, there we go. Henry's. Thank you, Dex. Henry's. There are banks out there that offer pretty good amount of, let's call it, benefits, and some that I don't think, a physician who's making good amount of money will pass up on. Because right now, currently, and if a SoFi individual is listening to this as constructive criticism, I'm going to actually give you constructive criticism. I highly recommend that you implement a program. If you want to keep a wealthy individual long term, you implement a program that gives them certain benefits that are up above and beyond what you currently have, the more that they have with you. I highly recommend that. And if any bank, if you work at a bank, and just if you are in a position to do that, I highly recommend that. If your target is retail customers, because you could also be working at a bank that's like, we don't care. We do not care because our target is like corporations. Like, we don't care about individuals. But if you're trying to target individuals, try to keep them really long term. You need to make sure that I believe you need to make sure that you have offerings or products that are really enticing to that person who could potentially put a lot of capital with you. SoFi currently doesn't offer that. SoFi has, something that I have recommended SoFi as a bank to some people in the past, but guess who it's been to? beginner people, like people who don't really have much money and who you know, have like they want to put a direct deposit, get a higher interest rate on savings, et cetera, and have that ease of like creating different accounts, because other banks will charge them money for it. But other banks will not charge you money for it if you have a certain amount with them. I think, like, for example, it's not even that much, by the way. Bank of America is like after 20,000. I think Chase Bank off the top of my head is like 15,000. And then they have different tiers. Truist has one now, like this whole tier system, so they did it as well. Chase's is not that good. Bank of America's, I think, is really good. Truist is actually good, but like not as good as Bank of America's. And other banks definitely have that out there as well. So there is a difficulty, getting back to the topic a little bit, but there's a difficulty with selling a product that you are also competing with that customer. And Tesla is in that position. When they said, we are going to license out FSD, my God, that would be amazing, right? That would be so much money for Tesla. And that would be the biggest bull case ever. That, honestly, that would be like, okay, everything any bear has said about Tesla is starting to not play out. Now, that's if they get to that stage. But I'm saying I have doubts about them getting to that stage because you have two viable competitors in my eyes. One more viable than the other because I have to see more, let's say, proof of concept from the other. But Mobileye, which I know is working with Volkswagen, and Waymo, who I don't know necessarily who they're working with off the top of my head. But those are two products that are competing against FSD, and they are not making cars. They are not. They're saying, okay, we have this product. SoFi issues is it's terrible for business. Oh, yeah. So there you go. And yes, Chase Private Client is very mid. We are in agreement, Garbage Goober. It's pretty mid. It's they should, but they don't care because Chase Bank, JP Morgan Chase, you know, their target customer. Well, actually, now with First Republic, things have actually changed. With First Republic, they do have a branch or arm of their business that's gives you, for example, like lines of credit at First Republic were. Well, now it still exists, but they're really good. They're really good at extending really cheap capital to you if you have a lot of money with them. And so it's still good service. And you do get really exemplary service from them. So it's not that it's bad. But yeah, the FSD licensing, that's the difficulty. Getting past regulatory standpoint, getting to that point where you're sitting in front of a customer and saying, hey, we compete against you. Here, pay us money. I think that's going to be a tough sell. And that's going to hinder growth, just like how we saw with SoFi. So going back full circle, that was the part of what the SoFi discussion was about way back when. And turns out Technisys and Galileo, their growth started to slow. They're having to impair those acquisitions because when those companies were separate entities, they probably had, and by the way, if you didn't know this about like tech sales has like a cycle that things go through. A lot of those new customers might have already been in talks and have already been, you know, demos have been done, people have been trained on it, and they were still kind of growing through that pipeline. And you do have a land and expand capability there. So when you sign up with Galileo or you sign up with Technisys, that doesn't mean it just ends right there. And that's like, oh, that's the revenue growth. No, there could be new accounts developed in the future. So they've already signed up with you. It's about getting that new client. And I think I glanced at it because I spent too much time maybe even looking at it. But there's the potential. I think they said that they're in talks with one regional bank. When I saw the announcement, or when I saw it in writing, I didn't see that it was mentioning anywhere the name of the bank, but that could be any bank. The point is, it's the growth rate. It's going to be a tough selling point, especially again when you have other competing products out there. But going to FSD, you have one hurdle that they have to overcome. And the main hurdle that they have to overcome is the regulatory framework. Because right now, Tesla is betting really hard on the visual full self-driving, not LiDAR-based full self-driving, visual full self-driving. Basically, all that means is cameras. So utilizing a camera. Now, regulators could come out and say, that's not safe enough. We're not allowing that. And now it's not really Tesla's fault in that case. Well, it's their fault for kind of not planning, but I doubt they're not testing also LiDAR systems. But that also brings up a whole can of worms. Like, what are they going to do with all the people they sold full self-driving capabilities to? Does this mean they get, there's some big major lawsuit? How does this work? And honestly, I don't have the answer to what would happen at that point. But what I do know is that I think that would cost them a bit of, let's say, advantage over some of their competitors that are testing right now in LiDAR, being Waymo and Mobileye. I think that would be probably one of the hardest hits to Tesla that I could see coming in the near term. Near term being within the next 10 years, is regulators just simply saying, nope, no visual tech, LiDAR, has to be LiDAR. So is Tesla a cult stock? Yes. Is it a compounder? Yes. Is PayPal a compounder? Well, I don't see PayPal exhibiting many of the concepts or cultural aspects that I see in Tesla or in Google. But like Tesla, I think is yet to prove itself in some of these things. Like, because them getting into robotics, I mean, that's so far-fetched. That's really far-fetched. And in this latest earnings call, I mean, you had almost them disagreeing with each other on if the robot's going to be useful at all. And then you have the other businesses where, okay, you can see the assembly of some of the advantages that being in this technology has helped you take advantages in another technology, etc. Now, getting back to the one issue about how they currently have a really perfect balance sheet, and again, how this is a product of their dilution. Well, if that dilution were to ever stop because the cost of diluting is going to be much more than just issuing debt, well, that advantage is probably going to go away. And I think that's a product of the stock price being so high. So you kind of have like a self-feeding loop right there. The stock price is really high, then the balance sheet is good. If the stock price is not very high, the balance sheet might not be as good. And remember that they paid off a lot of their debt when they issued stock way back when in, I think, 2019 or 2020. So they did have debt and they paid it all off. FSD has yet to get 30 seconds from my house. That's wild. Yeah, I haven't had any issues like that. So when I used it, then again, though, when I'm in the place where I'm exiting, I think I have like a lot of space. And then I don't really get into a very busy intersection with like pedestrians. There's not a lot of pedestrians. There might be a lot of pedestrians where you're at. Mine's kind of just cars on the road. So, and fewer and far between. And frankly, yeah, even when I'm getting into like a busy area, it's just all cars around me. It's not well, there are some times where I do have to step in, but I'm always kind of watching. So I don't have like that full trust with it whatsoever. So guy was bankrupt. Will they get a bailout? No, they're too small. They're definitely too small. ICOM, we have it set for around 8:30 to 9. So I will be closing it up here soon. Okay. Yeah, I'm just seeing if I had any messages. All right, and then the last topic of today, why I own Google. So Google, I think, exemplifies the topic of today's video, which is a true compounder. Google's primary business in advertising, digital ads, is probably like one of the best business models we've seen on this planet. Reason why is it's so asset light, and the control that which they've exhibited has been touted in some ways in a jealous tone by the likes of Microsoft, which Microsoft has Bing. And with Bing has never been able to actually penetrate the market in a way that was ever a threat to Alphabet. Alphabet has, though, one problem. Because their main business is so good, it seems like they've mostly been resting on a lot of their laurels. And if you really look at their most successful businesses, a lot of them are by proxy because they were very cheap and affordable, or like the free, essentially. I'm thinking of Android, or they're very similar to the search-based business. Really, if you really think about it, they haven't actually expanded out into anything completely different other than that. So anything in a meaningful way, okay? In a meaningful way, keyword. Because YouTube is a search engine almost, but for videos. It stores videos, and you can search them. You can search for things, and they're trying to improve on that. I will say YouTube as a streaming platform is, and I don't think this is not a profound idea, but it's the best out there. It's by far the best out there, and the unit economics are superior to anyone. No one can compete against YouTube. I think YouTube has already, it's going to be practically a monopoly in some sense. And I think it's dominating in streaming. If you're watching this on Twitch or on Twitter, I mean, most of the viewers are on YouTube, right? This is the place where most people are going to be and interact with things for a video perspective. And then you have creators that are basically creating content for viewers for free, right? For free, like as in Alphabet is not paying them. It's all ad supported. And then you have just a huge diversity of content. It's just like it's up for anyone. Anyone can upload a video. And so that adds a lot of diversity in terms of what you could watch. And people do it out of passion. Like you can find any kind of side hobby you want. You can find video tutorials. Just about anything you could ever think of is on YouTube. Alphabet or Google search is another form of also offering you information that is probably the only one that's under question of the serious businesses of Google. Because if you look at other chatbots that have seemingly similar capabilities of utilizing or presenting information, because at the end of the day, that's what Google search is, presenting information to you. Then that's where the question started. I think it was like in 2023, early 2023 with ChatGPT. Is Google's moat under question? Now, Google recently came out with their own language model that I think is also comparable, if not really good, and you can use it yourself. But how is the future chat models going to interact with humans and give us information, and how does that affect traditional Google search? That is yet to be seen. But knowing Google, they have a very strong cloud business, not the strongest, but a very strong cloud business. And if you think, oh, wait, Fabi, you said that they didn't have anything kind of away from search and YouTube. No, I'd count cloud as part of that. Let me explain why. Because the cloud was a necessity to build out in order to give the other businesses unit economic advantages. This is similar to how we were discussing earlier with Meta. So Meta invested a ton of CapEx into their hyperscalers in order to maximize the benefit that they could from their cost structure. So competitors like, let's say, TikTok, they don't have their own hyperscaler. So it costs them money to put content in front of you. Now for Meta, the economics are going to be way better because it's all in-house. So Google, same thing. When you're watching this on YouTube, who do you think's hosting this? When you're watching this on Twitch, who do you think's hosting this? When you're watching this on Twitter, who do you think's hosting this? Not Twitter. So for Twitter, it's expensive to show you this content. But for Twitch and for YouTube, it's not expensive to show you this content because Twitch has AWS and YouTube has Google Cloud. So this is a massive advantage in this space. Netflix doesn't have that. And Netflix is one of my largest investments. But Netflix, I think, uses AWS, I believe, or Azure. And so Azure or AWS is still collecting a fee for every time you use Netflix and watch content. Now, the other parts of Google that are quite successful. Let's take a look at Android. Android is really successful, and for the most part, their success is attributable to how cheap it was for you to utilize it in your product. So you wanted to make a phone, you need an operating system, and you have OS. Well, Google is offering it to you for practically for free. So you have to just basically build the phone and then sell it, and then you can take it. And all they ask for is, a little bit of backdoor into the data, and seems like a pretty good price to pay. So you get access to that hardware sales. And then there you go. Now you have a duopoly, iPhone with iOS and Android. And Google, that's one of their best businesses. You had also Gmail that was really dominant, still pretty dominant, but that's not really the best business. Still just search. Basically, the main business is data collection, and then cloud services. Those basically the two businesses that you can think of. Because YouTube, the only way it makes money is through data by video, data by presenting you a video and advertising to you, and then giving you enough entertainment that you're willing to even pay for YouTube Premium. That's another way that it benefits. And then Google Cloud, which is, finds enterprise customers or even small business customers that want to utilize, in some way the power of the cloud, so to speak. Okay. Bro's really shilling a company that's worth almost 2 trillion. They can't get any bigger. Well, big pharma shill. Or should I call you big fan of Eli Lilly? I would probably argue that the fundamentals of Google have, grown, 1.9 trillion. You're not getting the same deal you were just a couple years ago. Absolutely. And I'm not advocating for it as a buy, the point of bringing it up here is to illustrate an example of a more proven compounder, and it's not even the best one, but it's a good one. And one of the components or parts of the business that I think we can kind of point to as far as criticism, because I did say at the beginning of this video, I would also levy some criticism towards Google, is because its main business is so good, you have management that's kind of been asleep at the wheel. They've been asleep at the wheel for chatbots because marketing perception of the public is really important. Despite if you have a better product or not, the perception of the public is important. Branding is important. Go figure. So ChatGPT, when you ask someone, hey, what's an AI language model that you think of? ChatGPT comes to mind probably first, not Alphabet's. And that's a bit of a problem for Alphabet. Alphabet also kind of missed the ball on the assistant, the digital assistants. Alexa is the dominant. I always have to check. Alexa is the dominant player for sure by far. And when you kind of utilize or kind of compare it to the blunder that you had with Alexa, sorry, not Alexa, with Siri and Google Home, you see that Amazon has really dominated there. And that was Alphabet's to take, because now you can ask Alexa pretty decent search questions and it would give you an answer. It's going to provide to you an answer that you might have otherwise Googled. And if you look at some of these language models, they provide, if not the better, because in some cases they provide their results or their sources. I believe, for example, Google's new search feature, you can see when you sometimes search something, it provides an AI generated response. And now you're seeing that, okay, Google search is getting better in that way. So they are responding. It's not like they're just sitting down on their hands. But I think that the strength of their main business has really pushed management into some sort of lazy setback, but that hopefully they're waking up from now. You look at some of the other parts of, as far as like the employee quality at Google or Alphabet right now, you probably have noticed the complaints or some instances where you might question the person's job at Alphabet. Like, what are you even doing that you're earning $300,000, $400,000 a year and you seemingly have a lot of spare time on your hands? Well, this is also kind of brought to light and is forefront in Alphabet's mind right now, efficiency, trying to improve it. So they've woken up, but the fact that they've lasted so long with these inefficiencies, with these employees who have so much time on their hands that they're wanting to, I don't know, be more activist than just working, was a bit questionable or problematic. And I think they've woken up to it, but it's just a sign that management really hasn't been paying attention too much. Bobby's dream will finally realize he can day trade all business segments of mega cap tech. Oh, am I triggering your assistant? I apologize. Okay, so that pretty much covers the topics of today. I'm going to be heading off to the private live stream. So for club members, I will be seeing you shortly. If you liked this video or this live stream, please feel free to leave us a like. And if you're not subscribed, go ahead and subscribe. And I'll leave the floor for about 5 minutes to see if anyone has any last minute questions. This past couple minutes have been pretty much Q&A, but you guys can ask pretty much anything you want. And then the next 5 minutes, I'll get to the next, let's say, content. If I see no question come in soon, I'll just like close it off there, because there may not be any questions really. See a good amount of people in here. And let me actually, while that's going, let me just make sure that all right. So it looks like we didn't have any questions, because it's good. That means we covered every topic that we possibly could. How am I, Dex? I'm pretty good. I'm excited to talk about today's topics on ICOM. Alphabet or Amazon next 5 years, which is better investment? Amazon. What's your feelings on earnings season so far? So that's actually a good question, Big Pharma Shell. So earnings season so far, I think what I expected from Intel happened, which that's part of today's topic. We're going to be diving into Intel. And some of the other parts, like recently with some of the insurance stocks like Humana and United Health, we've been really seeing the cost push inflation. So That's kind of intriguing and reshaping a lot of the projections for those players. As far as Taiwan Semi, which has been kind of the most exciting one for me, that one was beat all my expectations. So it's been like some sectors and companies have really surprised me. Some have disappointed me, and then some of them have made me laugh. Some we've seen presentation. Well, that's not earnings day, but this tech presentation from PayPal kind of was more on the laugh part. I've been a Discord member since the beginning and still don't know what IC stands for. LOL. We'll tell you when we get to the when we get on. That's funny. Calvin Mindset, what is the bear case for Google use of AI? How bad could the bad be for you? If we see chinks to the armor in search, I would probably expect severe underperformance for the coming years, for as far as the eye can see for Alphabet. Because then what's the value in Alphabet? It's YouTube and Google Cloud. And then you'd have a declining business that's going to be a cash cow to the others. And you know, that could still work. That could still be a viable business, but that doesn't mean it's going to be a viable investment, because that, I mean, you're going to rate hard for that. Alphabet definitely is still priced that they're going to have digital ads dominance. And if they continue to have digital ads dominance, they can always increase the cost. And remember, every time we've shown this in the past, the amount of ads that are still not in the digital space, that are still done via like TV or legacy media, is quite insane. So they still have a lot of room to grow. And that's not just Alphabet's benefit, that's also to Meta's benefit, and also to Amazon's benefit. But Alphabet could capitalize on this in the future, and it could be really good. Yeah, Garbage Goober. We're going to answer that in the ICOM. Do you think the problem is that Google founders control all the voting shares and don't appear to care about the company at all? I think that is, yes, that I can see that as a problem, because they do it. Well, they would argue that they have that control so that they can make sure Google or Alphabet is taken care of and that's never misused. Because I feel like the founders of Alphabet are also those people that are, you know, hyper paranoid that the corporate America will take over Alphabet and turn it towards evil, et cetera. Because if you actually listen, they're actually quite political. If you listen to them speak before, they are very political. They're not involved in the company on an executive level anymore. They're just enjoying their lives, but they're quite opinionated. And so I wouldn't be surprised if they have that control and kind of this fear that they've created this very powerful company and they don't want it to be misused in their eyes, whatever they deem to be a misuse of it. And that could also be that's not necessarily a no, that they're part of the reason for its stagnation. They could be part of that reason that it's not advancing. They're not pushing change where it needs to be. They're focusing on maybe on the wrong reasons, on the wrong things. Yeah, that could be a reason. But again, it's a, you know how Warren Buffett said that you want to buy a business that a moron can run. I think Alphabet's almost one of those companies, because it's pretty incredible in terms of how much money this company can print and seemingly drop the ball again and again and again and again, and just kind of doesn't face consequences. That's again why it's been a big holding, a core holding of my portfolio for so long. And I don't see anything in sight causing me to sell. Will they die all their Class B? Yes, exactly. So once they pass away, it doesn't continue on. And so it does come to an end. Same with the Mark Zuckerbergs, by the way. So every time they sell shares, it converts to regular shares. And in the case of Google, because they have 3 classes of stock, it converts to Class A voting stock. And if they keep it, they have the elevated voting status. But if they sell any, it becomes Class A common stock. Okay. With that being said, guys, thank you guys so much for watching. And I'll see some of you on the ICOM, but some of you, I'll see you guys on the next live stream or video. And if you really like the channel and the content, feel free again to leave a like. If you're on Twitter, you know, you can retweet this or actually like it as well. And subscribe if you're not subscribed, or follow me on Twitter. With that being said, I'll see you guys in the next one. Bye. Oh, you know what? We'll do an outro. We'll do a little.
Okay. We'll do it live.
Okay.
We'll do it live. F it. Do it live. I'll write it and we'll do it live. F***ing thing sucks.